Alright guys, so in this video we will talk about a question that's often asked, which is what is a good rate of return for my investments? Now there are many types of investment and every asset class goes through a different cycle every 10 odd years or so, but a gold standard or a benchmark to compare your investment returns against is the S&P 500, which is a Standard and Poor 500, which is a stock market index that measures the performance of 500 large companies listed on US stock exchanges in the US. And historically, over 100 years, it has given a 7% rate of return. So, whatever investment idea you have or whatever investment you have put your money in, it should give you at least a 7% rate of return. If it's giving you less than 7%, then it should be offering you a lot more stability. And if somebody is promising you more than 7%, then you should assume that there is a lot more risk attached to that investment idea. If you live in a country where the currency depreciates or devalues against a stable currency like the USD a lot, then you need to also factor into account that depreciation or devaluation. So, for example, in Pakistan, the Pakistani rupee PKR has devalued about 6.3% year over year between 2010 and 2020 in the last 10 years. So when you're thinking about investments, you should expect a 7% normal rate of return plus the 6.3% devaluation rate of return. So about 13 to 14% depending on which currency you are looking into. Now, a simple way to think about these rate of returns is to learn the method of 72, which basically says that whatever rate of return you are expecting, divide 72 by that number, and you will get the number of years it will take you to double your money. So in the case of S&P 500, if we say that we are expecting a 7% year over year rate of return, 72 divided by 7 is 10. So in 10 years, you should see your money being doubled. So if you are investing $100,000 today, in 10 years, that $100,000 should be worth $200,000. In 20 years, $400,000. And in 30 years, $800,000. And this is the power of compounding, that year over year your money automatically increases based on the number of years it has been in the market. So if we look at how well S&P 500 has done year over year, we see that the S&P 500 in the last decade has done about 14.54% year over year. So that implies that if you had put in about $100,000 in the S&P 500 in 2010, you should have about $388,000 as of right now. And similarly, if you had invested in PKR in an investment, 1 crore rupees, you should at least have 6.6 crore rupees now at a rate of return of 20.86% based off the fact that 6.32% is the devaluation year over year of PKR against the USD. So whenever you think about your investments, right, you have to think about asset classes. Not every asset classes does well every decade. So for example, S&P 500 is an equity index, right? So there is a lot of theory out there that says that maybe the US equities will not do that well in the upcoming decades, the same way the Japanese equities market has not been doing well in the last 20-30 years. So you always have to spread your eggs across the market. Do not over leverage yourself or do not buy too much into one asset class. So for example, gold, right? So gold is one of the precious metals. In the precious metals class, you have silver, you have platinum, you have palladium. So if you had bought gold in the last 10 years, or even if you had bought all the precious metals, silver, platinum, palladium, even then the class in itself has not done very well. The equities market, the S&P 500, the US equities market is normally taken as a benchmark because over 100 years it has consistently performed very well. And that's the reason everybody kind of takes 7% as the benchmark. But overall, I would say that if you are looking into investments, you have to think about a portfolio. And equities is a part of that portfolio, right? So you have other asset classes as well. You have bonds, you have treasuries. There are many others, and I will probably make a video on that. But you shouldn't be putting too many eggs in one basket or one asset class. And even if you have to put something in one asset class, then the S&P 500 or US equities have historically been over a 100-year period done very, very well. But again, as I said before, there is a lot of theory out there these days that points towards maybe the US equities will not do that well in the upcoming 2-3 decades, and maybe this decade it will do 5% or 6%. But at the same time, the reason this is relevant is because a lot of investors, they come in and they kind of offer you pie in the sky rate of returns like 30%, 40%, 50%. That is not plausible or possible. Of course, in venture capital, in equity, private equity, there are those kind of returns, those X's, right? Like 2x, 5x, 10x. But unless you are a seasoned investor who exactly knows what you are doing, you are much better off just taking your money and putting it into an index fund that tracks the market and gives you a 7% rate of return against a stable currency like a USD. Alright guys, I hope you found this video helpful. If you have any other questions, please let me know in the comment section and I will answer that to the best of my ability. Thank you very much for watching and have a good one.